Welcome to On the Edge. I'm Max Kaiser. Time now to go to Bangkok and talk with John Kim, founder and chief investment strategist of Smart Knowledge U.
Thank you, Max. It's a pleasure to be back.
All right, first, your thoughts on the European Parliament voting to accept gold as collateral on loans to EU states, and now an outside force possibly being used to collect Greek taxes.
Well, I think that would just be inevitable because, as you've seen during the first quarter of net central bank purchases, which I believe I'm not positive, but I believe there are more than actually the last two quarters of net buying by central banks in 2010. We see that that countries and banks are evolving towards gold as money, even though they publicly may state it's not. They know it's an asset that they hold that is actually worth something.
Right now, getting over to this idea about an outside force being used to collect taxes in Greece. When the euro was first launched back in the early 2001 period, people were saying that, well, there's no central agency to collect taxes on these individual countries, and so it's going to be difficult to keep the euro intact. But what's going on in Greece now is that the country of Greece, the leadership in Greece, has deferred his authority to a European-wide and a global authority, effectively giving away the country's sovereignty to try to get the country people in that country to pay taxes. But what about this loss of sovereignty for Greece? Do you think the people in Greece are going to miss their sovereignty?
Oh, definitely. I think I don't think that the people of Greece really are keen on this idea. But as we all know, it's more what the people in control, the elite, maybe the 1% of wealthiest people in that country dictate, and the rest of the country has to follow. So I don't think you have any country where individuals have that sovereign, that sovereign right and sovereign power to determine what's best for them.
Now let's move on to gold and silver. You believe that the price action in silver in 2011 compares to the action in gold in 2008, and that both are signs of manipulation. Talk about that a little bit, John Kim.
Sure, because in 2008, actually, I noticed, since I live in Asia, that there are periods of time where gold would rise every day in Asian markets by $8, $9, $10 an ounce. And then exactly at 9:30 a.m. New York time, the price of gold would not only decline, but it would waterfall decline, Max. So it would lose sometimes $20, $30 an ounce in a matter of like 3, 4, 5 minutes. So, we're seeing a huge arbitrage position of gold being anywhere from $35 to sometimes even $50 an ounce higher in Asia. And so I don't think you have any free market where you're going to have that, that big of a, and you have to realize too, I think gold back then, gold today is at 1,500. So gold was trading numerically, as far as the US dollar price, like a lot less than. So it was percentage wise, it was a pretty large percentage difference within a 24-hour trading period.
Right. So you've got this arbitrage opening up between gold trading in Asia and gold trading in New York. What about this new gold futures contract that's now trading in Asia that's only been around for a month or so? Any changes now in the global market based on this new futures contract?
No, yeah, I think it's too early. It only started trading, I believe, May 18th. And even that was just a fraction of the total gold market. So I think silver futures aren't even set to trade on the Hong Kong Mercantile Exchange until July. What will be interesting to see is when they start trading in Chinese yuan. And also, we have to see how those futures contracts, on the daily transactions, how they settle. Are they selling in cash? Are they selling in actual physical delivery? One thing, actually, I'd like to bring up, Max, that I really haven't heard anyone speak of, but when I've looked at the CME daily reports for precious metals and gold and silver, most of the daily transactions now for gold futures and silver futures is not settling in cash, not selling in physical, but it's selling in something called EFP and EFS transactions. So the exchange of futures for physical and exchange of futures for swaps, which is really interesting.
Well, talk a little bit about that. So in other words, they're not settling in cash. We know that they prefer cash over physical because the inventories are drawn down to being nearly non-existent. And they're not settling in physical, they're settling in something else. Talk a little bit about what this something else is.
Well, the interesting thing is with the EFP swaps, the exchange of futures for physical, The laws were changed in 2005 to allow the substitution of ETFs, of gold-backed ETFs like the GLD and the IAU at the time to substitute actually for physical. So I believe, let me see, I wrote it down, that the exchange rule, which is 104.36, they actually allowed as a substitute for physical any commodity they said only needs, or anything that could substitute for the physical commodity, they say, quote unquote, need only be substantially the economic equivalent of the futures contract being exchanged. So it allowed basically paper to substitute for physical. And then actually after they passed that, they passed another law that said basically physical only, quote unquote, must have a high degree of price correlation to the underlying of the futures transaction so that the futures transaction would serve as an appropriate hedge for the related position. So what you have in the EFP and EFS swaps is just an allowance for paper to be traded for other paper. So in other words, like someone that's heavily short silver like JP Morgan or heavily short gold like HSBC never has to have, they don't have to have the physical. And the interesting thing, Max, is when I actually calculated for May, right? All the daily transactions up until May 27th that settled in cash, physical, EFP, and EFS. So for cash and gold futures, up 205,976 gold futures contracts that settled, only 0.01% settled in cash, 27% settled in physical, 78.2% settled as EFP transactions, and 21.50% settled as EFS transactions. So you have 99.72% of all transactions in the gold futures market settling as EFP or EFS. And for silver, it was 0.19% settling in cash, 0.93% settling in physical, 85.39% settling as EFP transactions, and 13.49% settling as EFS transactions for the month of May. So then again, you have 98.88% settling in these transactions. And it's a market change, Max, to how these transactions used to settle just like several years ago.
Yeah, I mean, this is remarkable, contrast the two stories here. You've got the banks on Wall Street. JP Morgan, of course, is the custodian for SLV, the paper version of physical metal. They are heavily short silver. They've been part of an investigation for rigging and market manipulation, the price of silver in London, along with HSBC. And they're building out their pyramid of naked shorts and market manipulation and fraud as it relates to physical silver. Of course, JP Morgan and Goldman Sachs are part of the global banking system. That includes the IMF, of course, because the IMF is mostly U.S. banks. So the IMF and the folks in Europe are telling Greece that they're making their gold eligible as collateral against the paper loans. So here you have an interesting global arbitrage, if you will. And you can see how the wealth is being confiscated from countries like Greece by just contrasting these two stories. Here the IMF is saying, we'll take your physical gold in exchange for our worthless paper debts that we created on your behalf without your legal right. At the same time, they're saying in New York that we'll accept paper to settle these physical contracts as a way to keep the price cheap for now while we're going on our global sovereignty-destroying spree of imperial conquest. So two stories concatenated together, it should open people's eyes to how this gold and silver price is being manipulated and used to steal gold from some countries and to enlarge the Christmas bonuses of the banks on Wall Street. All right, now getting back to the manipulation story, JP Morgan, of course, opened a vault on the COMEX to store some precious metals, but they're not subject to be audited in any way. Is that just another part of their overall fraudulent market manipulation hijinks?
Yeah, before I get to that, I just want to cover one thing real quickly, Max. The interesting thing is when I believe it was GATA that first uncovered the idea that, or the law change that allowed paper ETFs to be substituted for physical in these EFP transactions that take place on the COMEX. And at that time, some bank apologists or banker shills, whatever you want to call them, said, it doesn't matter if paper is being substituted for physical because these transactions only constitute such a small percent of the daily futures transactions that, it's irrelevant. But now I wonder what would be their rebuttal now that, the EFP transactions, like I said, for the month of May, for gold, were basically consisting of 78.2% of all the transactions cumulatively in the month of May for gold futures, and for silver is 85%, right? So it's a very substantial, it's the bulk of, futures transactions that are being conducted are these paper-for-paper possible swaps. And getting to your point about JP Morgan, interestingly enough, JP Morgan was as of the end of 2010, was one of the largest holders of the SLV, and they owned, I believe it was 3.6 million shares. So I'm also wondering if they own these shares to be able to, swap these shares to close out their short position in some of these, shady EFP and EFS transactions that are going on. I haven't fully been able to connect the dots, but the explosion of these transactions and the fact that the bulk of these gold futures transactions and the silver futures transactions are now in EFP and EFS transactions, I mean, that should raise a huge question mark.